Hey everybody, I hope everyone is doing well and had a good day today. In this video, I will review the Emini 5-minute chart for Tuesday, October 21st, 2025. This format will be a little bit different than what you're used to, and the purpose is to demonstrate that you don't have to be able to talk about a chart for a couple of hours to make an end-of-day review. And one of the messages I want to get across is I encourage everybody to make your own end-of-day review. So let's get right into it. Going into the day, we can see tight trading range on the open, or before the open at the close of yesterday. Small gap going into the day, so I'm going to use the prior day's pattern to continue talking about the chart into the day. So tight trading range, legs lasting 3 or 4 bars only. So very minor patterns through here. And we start to get range expansion as the bears get a bear breakout. We broke below bar 79 on bar 1, pulled back, broke below bar 1 on 3 and 4, pulled back, implied pullback, opposite bar on 5, and then another push down 6 and 7. So the bears already have at least 2 or 3 legs down. You can call it a spike in channel, spike, pullback, low 2 short, tight channel, 1 leg here, pause, second leg down, so maybe it's 3 total legs. And then we had before we get into reversal, what happened on bar 7? The market is far below the moving average. The traders selling bar 7 know they're selling a late leg 1, 2, 3, far below the moving average after a tight trading range. So this is a fairly weak breakout for the bears down to bar 7, even though it's a micro channel from 2 to 7. You've got tails below bars. Where are the consecutive strong bear bars? You've got an opposite bar on bar 5. It's a late leg by the time you get to 7. So there's a lot going against the bear case. The problem is the stop location. Bears, let's say they hypothetically or theoretically put a stop at the high of bar 2, and they're selling the close of 7. It's a lot of risk to take on the trade when the structure is suggesting we may pull back here because you've already got a late leg in a channel, exhausted bears, they're buying back shorts. You've got bulls buying, scaling into longs, expecting a bounce, and that's what happens. Tight trading range, weak breakout, reversion to the mean. We test this, it looks like about the middle of this tight trading range up on bar 11. And this breakout is strong enough that you know there are trapped traders below. Second leg up likely. And what kind of pattern is this? You can call it a small, higher low major trend reversal, spike and tight channel, bear trend line break. So bulls broke the bear trend line with consecutive strong bars crossing the moving average. They even got a bar completely above the moving average on bar 11. Sharp retest of the lows on bar 12, but no follow through. Reversal 13. Bull reversal bar closing on its high. So bulls get their breakout, pull back, second leg to a new high. Now bar 18, it's a strong 3-bar micro channel, 16, 17, 18. But now we've got 2 legs up, and it's still a trading range environment. You've got maybe 5 consecutive bars closing above the moving average, but most of the bars to the left are pretty flat on the moving average. They're either on the moving average or below. So this is not clearly a bull trend on bar 18. What happens? It's the same as what happened down here. Bar 18, bulls are buying. They're buying closes. Looks like a strong bull breakout, but they're disappointed with 19. The bulls buying 18, they're buying far above the moving average. Their premise is that they're buying momentum. And if there's not momentum, if you buy the close 18 and your entry bar is 19, then you're disappointed. You're buying momentum, you're paying far above the moving average, the average price, and the market moves against you. So what do the bulls who bought the close of 18 do? They exit at their original entry on 20 and 21. Even if a bull bought 18 and they were not quick enough to exit here, as you can see, some of them did, But even those that didn't, or bulls who did not buy at all, they're waiting to buy a pullback. Maybe they start buying a breakout point, or maybe they start buying a third leg down. Maybe it's 1, pullback, 2, pullback, 3. Strong enough bull breakout, 3 legs sideways to down. Compare the strength of 16 through 18 to 19 to 26. One of the ways you can look at a chart when you're looking at price action breakouts is to measure the strength of breakout versus breakout. So bull breakout versus bear breakout. This looks like a bull breakout, second leg up likely. This looks like a trading range or a channel for the bears. There's more overlapping bars with big tails, periods of sideways. So this might be a bear channel, bull flag, bull breakout, bull flag, bulls get a second leg in this small tight channel. So maybe 3 or 4 legs up here to a new high. But we know bulls who bought here, 18, 21, this area, they were disappointed the last time they bought there. The market sold off. So what's going to happen? Spike and channel, testing resistance, try to break out to a new high. Bulls never get follow through. Small breakout 37, bad follow through. Small breakout 40, and then big reversal 41. Bear surprise, second leg down, likely. With follow through, then sort of a deep pullback, maybe a 50% pullback. That's enough to disappoint the bears who are selling. So maybe they scalp out. Bears sell, maybe they sell more at the moving average on a pullback, but then they scalp out 46, 47. And here this created a triangle. So you can count 1, 2, 3 pushes down, 1, 2 pushes up. So a 5 push pattern. Markets in breakout mode. It's probably close to 50-50. You can make an argument that the bear breakout still needs a second piece down. You can also argue it's a trading range day with a bigger bull breakout here, spike and channel. This is simply a deep pullback to a higher low, and bulls are buying the breakout point here. So there's arguments for both sides. Triangle, breakout mode, bulls get the breakout. 51, breakout pullback on the same bar, and then follow through, spike and tight channel, 52 to 57. Second leg up likely. Minor reversal, 57, 58. Bulls get a retest. This is a small. The bears are hoping it's a higher high, major trend reversal. So bull trend on a smaller time frame, talking about maybe the 1 minute chart. Bull trend line break, retest to a higher high, and then bears hoping for the major reversal. But in most cases, major reversals or major trend reversal attempts lead to trading ranges. So in this case, we got the trading range, more sideways. So market went sideways into the close. Another maybe 3 push pattern down, 1, 2, 3 legs down, bull breakout, maybe it's a bull flag. Bulls get their second leg. But now you've got a late leg, breakout, complex pullback, second leg, testing resistance, maybe high in a trading range on a trading range day. Getting late in the day, day structure is pretty apparent, and that leads to a lot of selling on 78. So some traders, maybe they view it as a second leg trap. Maybe this is the first leg, this is the second leg. Even here, these 3 bars, 75, it's big, small, big, volatility, expansion, volatility, contraction, volatility, expansion. So even on a smaller time frame, these 3 bars is a breakout, pause, and a second leg. But the problem is that 77 was a vacuum test of resistance, and the market sold off, and you can see eventually the bear breakout 41 with follow through had a complex pullback, caught a low 3 over here, and eventually it got its symmetrical second leg down. That's going to be it for today's end of day review. So thanks everybody for watching, and I hope everybody has a good night.